Hello, everyone, and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video, we are at our last stretch for the FM pre-December 2024 mock exam. We are left with the last case study based question for scenario for section C. The name of the company is BrightPath and BrightPath proposal, where we are evaluating this for Luminex Corp. So let's have a quick read of the scenario. Firstly, the requirement wants me to select to evaluate if the BrightPath proposal is financially acceptable to Luminex Corp. Let's see what the proposal is all about. Embarking on a journey to refine its working capital management and increase dividend payouts, Luminex Corp's finance manager is actively seeking strategies for improvement. Luminex Corp generates annual revenue from credit sales amounting to $36 million, despite requiring all credit customers to settle invoices within 30 days. Customers often take longer. Roughly 0.5% of credit sales result in irrecoverable debts that remain outstanding and unrecovered. Trade receivables currently stand at $5 million, and Luminex Corp incurs a short term finance cost of 8% per year. Considering a proposal from a factoring company, BrightPath offered to manage its sales ledger on a with recourse basis. So I will highlight this. They are offering us factoring on a with recourse basis. That means if our customers default on making the payments, this factoring company, BrightPath, is going to come back to us and take the money from us if the customers don't pay. BrightPath aims to leverage its expertise to reduce average trade receivable days to 20 days while cutting irrecoverable debts by 80% and lower administration costs by $120,000 annually. As a part of the factoring agreement, the BrightPath company would advance Luminex Corp 70% of the invoice value at an interest rate of 9% per year. BrightPath would levy an annual fee of 1.25% of credit sales. Assume that there are 360 days in 1 year. So now coming back to the requirement, we need to evaluate whether it is financially acceptable for them. So let's draw a comparison as to what are the different costs under both of the methods, and if we adopt, what will be the benefit for us. So firstly, we will consider if we manage on our own. So if proposal is not taken, proposal is not accepted, or you can also say that this is our current scenario. So in our current scenario, we are presently, let's start off with the admin costs. So we have admin costs as $120,000. The next thing which we are going to consider over here is with respect to the irrecoverable debts, the bad debts. So 0.5% of credit sales go as irrecoverable debts. Irrecoverable debts. This is 0.5% of the credit sales. Credit sales are given to us as $36 million. So this is what our irrecoverable debts look like at the moment. And then the last thing is that we need to incur short-term finance interest on the receivables. So short-term finance cost. So the short-term finance cost over here is going to be, it's written that we pay 8% per year on the receivables. So let's see how much is our receivables. Receivables is $5 million, and on that we incur 8%. So 5 million multiplied by 8%. So this is our short-term finance cost. So if you total all of these costs, the sum total of all of this is what you are incurring in the present scenario. Now, if you go ahead with the factoring service, factoring by BrightPath, if this happens, then what are going to be the particulars? First of all, you will be incurring the factor fee. So let's calculate the factor fee. This is the easiest thing to do. It's given as a percentage of your revenue. So 1.25% of your credit sales 1.25% multiplied by 36 million is what our credit sales looks like. So they're going to take $450,000 from us in form of factor fee. Now, irrecoverable debts, as this is something on a with recourse basis, so there are still going to be irrecoverable debts. They are going to reduce it by 20%, but still by 80%, but still it is going to be there. So there, the calculation that we will be doing to find out how much of irrecoverable debts we will be left with is our irrecoverable debts were 180,000 at the moment. Now, there are two ways to arrive at this. Basically, your debts are going to be 80% lesser. So you can take earlier what was your irrecoverable debt and simply take 20% of that. So this way you will work out these are your irrecoverable debts. If they reduce by 80%, that means 20% will be left. So that gives you 36,000. So these will be your irrecoverable debts. Another method basically would be to go for the longer calculation where you take 36 million, multiply that by 0.5% because that is your irrecoverable debts, but that we have already found out over here, and then multiply that by 20%. So this is how you will calculate the irrecoverable debts. This much amount will still be there because it's on a with recourse basis. If these people do not pay up, you will have to pay as a company to Bright Path. Now, another cost which you will find over here will be with respect to the factor finance cost on the average receivables. So it's written over here that they are going to be offering you 70% of invoice value at interest rate of 9% per year. So basically, if this is the short-term finance cost, it's essentially this one over here. How much would this be now? Is that on your 36 million of sales, you need to find out, divide that by 360 because you need to convert it for the number of days that you are, having the receivables. It's 20. So 20 divided by 360. Let's put the numbers side by side. 36 million. If you multiply this with 20 divided by 360, that will give you the number, this will give you the number of receivables, the amount of receivables that you have. Now they are going to give you 70% of that value. So your loan amount will be 70% of this, and you will be paying an interest of 9% on this very amount. So you multiply this with 9%. So with this, you're going to get 126,000 as the short-term finance costs. And another thing which you're going to take is the short-term finance interest on the remaining receivables. So short-term finance interest on remaining receivables. Now 70% they are giving you. Remainder 30% you will be continuing to take from the bank itself. So your amount was 36 million multiplied by 20 divided by 360. This is the amount of your receivables. Of this amount, you will be taking 30%. And on this 30%, you will continue to pay the interest that the bank was charging from you. And bank was charging you 8% per year. So you multiply this with 0.08 or 8%. So with this, you will find out the balance that you will be, taking on a short-term finance from the bank itself. Now, if you can find out the sum, this is the total of all the costs we will be incurring if we go ahead with the factor. And with this, the costs come out to be 660,000. If you do it on your own, the total looks like 700,000. If you get it done with the factors, it's going to be 660. So in net effect, we have a saving. And how much is that saving coming out to be? It's going to be the difference between 70,000 and 660, which gives you 40,000. So that means if you go for this option, factors offer is actually financially acceptable to Luminex company because you are having a benefit rather than a cost. So you will leave a comment here because they are asking you financial acceptability. You're going to in bold write the word comment. And in the next line, you're going to say that the proposal, or you can say the Bright Path proposal, is financially acceptable as it brings Luminex Corp, Luminex Corp a saving of $40,000. This is how we complete the requirement which was carrying 8 marks. Now we move ahead to the further requirements. Part B wants you to discuss the factors to consider in shaping the dividend policy of a publicly listed company on the stock exchange. Part C wants you to explain any two Islamic financial instruments available to businesses. Now, these are generic questions which are not even related to the scenario. Do not expect that in your real exam, in your final exam, also you're going to have such easy questions which are direct theory based questions which are not going to ask you to link it to the scenario. So this is something which I would say that the level of the mock has been very easy. So many easy requirements. Even the first question which pertained to the NPV investment appraisal, that question was super easy. This also they've put 12 marks of very easy requirements. So please do not be do not feel very overconfident by gaining good marks in this sort of a mock, because definitely telling you that ACCA final exam is going to be a level higher than this. So now coming to the factors that any company should consider in shaping the dividend policy of a publicly listed company on the stock exchange, there will be a variety of factors which need to be considered. Firstly, you will see how sustainable the business is. That means, is the business able to make profits for a consistent period of time for the coming future? And if you go for a conservative dividend policy, that means if you're paying lesser amount of dividend, and even if you're not paying any dividend, that should also be considered when the business is making losses. So the first thing that you will consider is the sustainability of business. Another factor which you will consider while deciding for the dividend is about the law. Many countries have a legislation which, permit the companies to only pay dividends out of accumulated net distributable profits. For example, UK has this law. So distributable profit of the company is only the factor which will allow the businesses to go for dividends. If the company does not have any accumulated profit, they cannot possibly be using any of their reserves to give dividends to the shareholders. So this is one thing. Another thing which companies will consider is the covenants. Covenants means the terms and conditions which are attached when a company gets into any loan agreement. So if I am a company, I go ahead and take a loan with a bank. Bank may put some conditions on me that you're not allowed to pay more than this amount of dividend to your shareholders. So if I have any such agreements, then obviously I'm going to be bound by that. So that will also affect how much dividend I pay to my shareholders. Also, there can be government restrictions when I have taken any loan. There can be government restrictions also that this is the maximum amount of dividend that you can pay to your shareholders. Moving ahead to another factor could be the liquidity of the company. So a lot of times you would see that company is making profits, but those profits are still in the investment. That means the cash is not there with the company yet. They are making profits, but maybe they are not selling off their asset yet. So it is in profit, but it is only notional profit. It is not realized because you've not sold your asset as yet. So dividends involve paying out cash, right? So if the company has profits but it has no cash, can it pay any dividend? No, right? So dividends are a cash payment. Company must have enough cash to pay the dividends without compromising the day-to-day functioning of the company. So if they have to pay any debt in the near future, that will also need to be considered because cash will also be needed to pay off the debt that they have to pay. Next factor could be about the gearing. Gearing means how much debt a company has in its capital structure. So if the gearing is high, then a low dividend payout will help the retained earnings to be high, and it will reduce the level of gearing because the reserves will be higher. Moving ahead to another point, this could be the accessibility to alternative sources of finance. Alternative sources of finance. What do we mean by this is that if a business has enough availability of finances from other sources, let's suppose I as a business need money and I have ample options available with me. There are banks who are willing to pay me to give me loans. There are other investors who are ready to invest in my company. There are other people who would probably some institutional bodies which are ready to give me a loan. So if I have so many options, then I would not mind paying dividend because I will raise money from other sources. So if it is very easy for a company to raise money from other sources than retained earnings, then they can easily give dividends. But if you talk about small companies, nobody wants to give money on loan to the small companies because you never know, they may shut overnight. So those companies heavily have to rely over the retained earnings because they do not have any other sources. And the last factor, this is not an exhaustive list, there could be multiple other factors which you could add. Another thing is the signaling effect. Signaling effect means signaling comes from the word signal. So, how do your investors take as a signal how much dividend you are paying? So if you pay a very good amount of dividend, investors will think it will give that a signal to the investors that the company is doing very well. So you want to also consider what you want the investors to think about you. If you want that the investors should think you're a very good company, then you should be giving higher dividends also. Moving to the third requirement now, where you have to explain any two Islamic financial instruments available. You have studied a lot of financial instruments, Islamic ones, in the financial management syllabus. So it is upon you. There is no linkage to the scenario which needs to be done. So you can explain any two which you have learned properly. Mudaraba, Musharaka, Murabaha, Sukuk, and these are the all different Islamic instruments that we have studied. So any which you feel is something which you remember well, you could talk about that. But before you do that, just start with the fact that why is Islamic finance there? So because according to the religion of Islam, there are some different principles that they follow with respect to money. What are the different principles? That charging interest is not allowed in Islam. So this makes a lot of money instruments that we have conventionally impossible to use for the people who follow this religion. So they have created their own instruments which are acceptable under the Sharia law. It's the law that the Muslims follow. So these are the instruments which are in accordance with the Islamic finance principles, and then you can go on to explain any two. Also note that here, because you're writing two instruments for 6 marks, every instrument that you explain carries 3 marks. So ensure that you write in good detail about this. With this, we are through with the FM pre-December 2024 mock exam. I hope that this debrief, the entire series that I have made of all of the covering all of the mock, has been useful for you. I hope that you gained value out of it, and I wish you all the very best for your final exam. I hope that the exam goes really well for you and you score very good marks. Thank you so much for watching.